Hi guys. So today I will be sharing the three stocks to buy right now. Um the market has been down for a while, and the question is, should I buy stock or should I not buy? So it's always been a very hot question whenever there is a dip. People don't know when to buy and when to stay out of the market. So in this tutorial, on this guide, I'm going to show you how I picked three stocks. Although I bought more stocks to actually top of my portfolio, but there are three key stocks that I added to my portfolio. Although I own one of them, I had to sell off at the peak of the um, when I noticed that the price was going to dip, and then I bought again. I had to enter at the lower price so that I could take advantage of the bottom and also ride the top. So instead of holding the stock while it's at the top, I was smart enough to sell and wait for the price to dip to the bottom. And when I noticed the sign of the bottom, I quickly bought. Now, in short, I've not even finished buying the stock. So I'm entering gradually while watching the market. The moment I see a sign of full recovery, I'm going to go big. But I've started buying a lot units in these companies. So what are the stock that I recently bought in the US market? So before I tell you these stocks, I want to quickly share how I buy stock, how I take that buy decision when the market is going down, and at what point um, I actually determine when it's right for me to start buying stock. Now, like I always tell my subscribers, the NSC, the SPS, sorry, the SPS had always been on a long-term uptrend. So right from 1998, you can see here the SPS, which is S&P 500, the market index have always been on a long-term uptrend. So no matter what happened in the US stock market, you will see that the market tends to bounce back from the bottom. Right here, I'm taking you back to 90. You can see here. Let's start from 1995 or 1990. 3, 4, 1990. Okay, this is perfect. Now you notice the long-term trend in the market, how the market has rallied so high. Can you notice here how the market has rallied so high from this point? So between 2000 to 2012, 2002, we had a massive dip. You can see how the market dipped from 1,500 basis points up to 824, and that's like 2 years. Then the market recovered again between 2002 to 2007. Then we also had another dip. This was the market crash, financial crisis. Then how the market dipped from 2007 down to 2009, and then we saw another major recovery from the bottom of the market to where it's selling right now. You can see here we've had a long-term uptrend. So can the stock market crash? That's a topic for another day. So, but here you see that how the how the SPS had been on a long-term uptrend. So even when there is dip, which is normal correction, we've had a bounce back. You can see here we've had a bounce back. So right now the market is down by 2.01% in January. That's this month. And if you check other indices like Dow Jones average, you also notice the same pattern. Dow Jones is down by 0.74. You see, so when there's dip, the market will always bounce back. When there's dip, the market will always bounce back. So that now leads us to the next question. Are we in a bull market or a bear market? So these are questions you need to start asking yourself. Are we in a bull market or a bear market? So the SPS index itself, it's on a bull run. It's still on a bull run. Why? How did I say so? I always, if you've watched my previous video, you will see how I talk about this moving average. Now, this moving average is a simple gauge of a bull run or a bear run. So when the price or when the index is trading largely above the averages, with each average lined up in sequence above each other, that tells you that the bull is still strong. But in between, there will always be correction, 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 correction. So it's like breathe in, breathe out, breathe in, breathe out, breathe in, breathe out. So there will always be correction in the markets. So, which is what I just demonstrated right now. Then, if you go back to our daily charts, so this is daily chart of Dow Jones, you will see how the market has traded largely above the index, the average, and each time, anytime it pulls back, it tends to find support. Like here, 50, you can see on the 50 average, 50 can see here close to 100, close to 100, and then this place you see close to this is 150, 150, and then at some point it dip below, then quickly bounce back. So I'm sure if I add another average here, which is 200, this will likely be around the 200 days moving average because this here is 150. So I'm sure this is going to be 200 and then bounce back. So the market always finds support at any of this moving average. Now, recently, you see in the last 1 week how the market has also dipped significantly, and then notice how it found support at the 50 days. This is a bullish candlestick. We call this pin bar. We call this pin bar. So pin bar, it's like rejection, meaning that the buyers were able to step in to take control of the price. This particular index dipped to a low of 35,639, but the market was able to push it back to 36,000 basis points. So let's look at the SPS too. Now look at the SPS. You can see another pin bar again. So how the index dipped to a low of 4,582 from an open of 4,006. But the buyers were able to step in to move it significantly up from 4,582 to 4,670. And then the index closed at 0 - 0.14. So from here, it's now left for me to see what happened the market the following day. So if this index opens higher, that's a sure bet that there is now a reversal. So, but the reversal does not necessarily mean that the dip is over until we are able to see the market clear this resistance at 4,792. So we have a major resistance right here. So a major hurdle to be broken. If the market is able to break this, then the continuous trend. So the question is it the time for me to buy my stock now? Seeing that each time, whenever the index pulls back to any of this major average, I always like the index to pull back to 100. For me, I see 100 as healthy pullback. That's from my own end. I see 100 as healthy pullback. So price does not pull back to 100 every time. You notice here, each time it pulls back to the 100, like here, the last time it pulls back to 100 in 2020 was October. Now, if you had started buying stock from this point, and then you notice how the market had rallied from that point, which is 3,293 to this point where we had the next pullback to this average, and then down to this point. You can see here down to this point. So is this the best time for me to start buying stock? Yes, it is. So, but I'm applying caution at this point. Why am I buying stock now? Because the index actually found support at one of the averages, and seeing this pin bar is a sign that buyers have stepped in. So we now need to see, just like we had here, you can see the same pin bar right here. So you might ask, what is pin bar in the stock market? No, if you trade forex too, you would have heard of pin bar, pin bar, pin bar. So this is how the pin bar looks like. So this is how pin bar looks like. Look at this. So this is how pin bar looks like. You have a candle with a long wick. You have a candle with a long wick, either to the upside or to the downside. What does this mean? If this market close higher, just like we have here, you can see this is the closing price, this is the opening price, this is the weak, and this is the low price. So it means that the market opened right here, and then it dipped to a low of this at this point. But buyers were able to step in to move the price upward, and it closed higher. So this is a bullish sign. It's a sign of reversal. But when you see it in a downtrend, when you see it when market has been going down successively, it's a sign that there is a reversal in sight. The same thing happened right here. When you see the market going up successively, and you see price, this is a high, this is a week, this is a high for the day, and then this is the open, and then this is the close. So the market opened right here. It went as high as reaching at this point. But sellers at this point were able to step in to sell off, and then the market closed here. So it's a sign of reversal in a bullish market. So let's go back to our charts. Now you can see the same pin bar right here. The market had been going down right here. You can see the last 1 week, and then at the end of the day, buyers were able to step in at this point after reaching a low of 4,582. So that's why I am buying stock right now, because I see a reversal in sight. So you are following the trend. When you notice how the market had found support at one of the major averages, and you can see that this region also coincide as a major support. You can see here as a major support. The market had dipped to that level before, dipped again. You can see dip. So we have one, two, three. So this is like a triple bottom, which was once a resistance before. You can see during previous uptrend how the market found resistance here, dipped, and eventually cleared this line. Then when it pulled back to the same region. So you can see right here. So which is why I consider this region a very, very important area that requires me to step in to buy some stock. Like I said, I'm not going to buy all the units I want to buy at the same time. I've bought some units, then I'm watching. Let me see what happened going forward. So one of the stocks that I've added to my portfolio is Nvidia. Now this is a stock that I sold. This is a stock I sold at the top of the market. So this is Nvidia. I sold this stock on its way down, hoping that I will buy back at the lower end of the market. Now you see how Nvidia stock tends to bounce back or bounce from the moving averages. You can see right here, we had a previous dip in May, we had another dip. So I'm looking at healthy correction. My definition of healthy correction is a pullback to the moving average, especially the 100 days moving average. So we had healthy pullback here. That's 180, 138. Notice how the market rallied from then to where it is right now. We had another healthy pullback to 196. Then you can see how the market has rallied again, and then we have another healthy pullback right here. You can see how Nvidia went up by 0.56%. So I started keying in Nvidia at lesser price than this. So Nvidia closed at 274 US dollars. So this is one stock that I'm buying. Now, why am I buying Nvidia? That's the question that we need to answer right now. So let me show you some of the reasons I'm buying Nvidia stock. First, let's look at the trend. Nvidia is still largely in a very strong uptrend. You can see how the moving average, 50 days moving average, is still above the 100, and then you can see how the moving average are lined up, and then with 50 days still pointing to the upside. That tells you that this is a very, very bullish stock to buy. This stock is very, very, very strong in its uptrend. So this pullback from a high of over 346 down to this low of 260 is considered healthy. So for me, I consider this a healthy pullback. I consider this a healthy pullback. So if you had relied on the 50 days moving average, I wouldn't say is wrong, but to a very large extent, if you look at the rally above the 50 days moving average, just like here, one, two, and then 50, you can see here. So if you had relied on this at this point, this would have failed. And if you had also relied on the pullback to the 50 days here, you can see how. So I like to see my pullback healthy, and healthy pullback is to the 100 days moving average. So Nvidia right now is selling at a critical support region, which is 100 days moving average. Then number two, from fundamentals, if you followed my analysis of fundamentals, you will see that I do not buy any stock that is considered expensive. So we also need to look at the fundamentals of Nvidia. Let's see if it's still a cheap stock to buy. So here we're going to launch the financials of Nvidia. So let's look at the financials. Now, I like to see my stock achieve consistent growth in revenue, profit, cash flow, and also not exposed to debt. So if a stock has achieved consistent growth in revenue in the last 2 or 3 years, profits, lower debts, like what I mean by lower debt exposure, it means that interest cover is at least above 2. And then cash flow is positive, both the operating cash flow and free cash flow, and is also considered undervalued using my fair value estimates. Then I quickly jump on that stock. No, now you see Nvidia. From here we have 11, 10, 2020, 10, 16, 24. So this is consistent growth in the last 3 years. And then I consider this too, which is trailing 12 month. I already explained what trailing 12 month is. And then my net income, you see 2.7, 4.3, and 8.2. So earnings before interest and tax and interest expenses, 9.9 billion, and then 228 million. So 228 million. So you can see interest expenses compared to any before interest and tax is not even anywhere close. So this is a good interest cover. So let's look at the cash flow of Nvidia. What's the cash flow position of this company like right now? So see the company is cash flow positive, still cash flow positive, 4.7, 5.8, and 8.1. And what's the operating cash flow? 4.2, 4.6, and 7.1 billion. So let's quickly plug in our figure. So this is 7156. So I'll come here, 7156. 1, 2, 3, 1, 2, 3. And then what is the projected growth in the next 5 years? So I've always talked about the importance of always buying stocks that are undervalued. Now, why are you buying stocks that are considered cheap? The reason is that you want to plug into companies that institutional investors will likely be buying, companies that mutual funds will likely be buying, because at this point they are considered cheap and the sell-off looks extreme. So when you go into such stocks, when you buy into such stocks, you are most likely following the money. In you are putting your money in stocks that institutional investors are likely going to be buying. And when this guy steps in, that is a way. That means your stock is going to appreciate, because as they buy more of that unit, they are not coming in with $1,000, they are coming in with millions of USD. And you know what that means when they start pouring money into certain stocks that are considered cheap. So that's why you need to do your fair value calculation on the stocks that you buy. So let me refresh this. Okay, so analysts are projecting a growth rate of 37.37%. So let's go with 30%. I like to be fair and modest in my estimate so that I don't exaggerate the value of a company. So statistics. So let's look at the cash position, the debt position, and also the number of ordinary shares outstanding as at today on that stock. Okay, so the cash position of Nvidia right now is 19.3 billion. So I would quickly plug in my cash position of 19.3 billion, and then The debt position of Nvidia right now is 11.83 billion. 11.83 billion. 11.83. And what is the number of ordinary shares outstanding? It's 2.49. So I'll quickly come here. 2.49 billion. So having plugged my data from my free cash flow to estimated growth rates to cash level, cash position, debt position, and outstanding debt, you can see right here. mm, Sorry, I didn't plug in the symbol very well. That's why. Okay, so you can see that the Nvidia should be selling close to 299. So my fair value of Nvidia is $299, and current share price is 274. Margin of safety is 209. So this is a stock that I considered cheap. This is a stock that I considered cheap. So if we go back to our fair value here, you can see that as the stock dipped to 259, 260, I considered it undervalued because it's far lower than the intrinsic value, my estimated intrinsic value. Now, remember, this is an estimate. So, if we had imputed the 39% projection, 39% projection that analysts are placing on this stock, we would have much higher. You can see at 488 USD. So which is, you can see here. So that means the stock is 78% undervalued. So the price at this 259, 260 is considered a good entry. So from my technical setup, which is the fact that the stock is oversold at one of these averages, and number two, overall market also seems to have been oversold already. So which I think would also support the rally, because it's these stocks that make up the index. Index is not another company entirely. Index is made up of several stocks. So when the index is bouncing back from a major average, it calls for you to start looking at few or selected stocks that will also bounce back. But you would make much money, much profit when you're able to spot stocks that are undervalued, because these are the ones that are going to attract a lot of buying interest. These are the stocks that will bounce back first because their prices are far below their intrinsic value. So that's why Nvidia is one of the companies I am buying into right now. So that's one stock. Now the second stock that I'm buying is MMC, Marsh and McLennan Companies. So Marsh and McLennan Company. So this is it. Now you notice again how the index, sorry, how the averages are lined up sequentially, and then look at the key support line. You can see here how this had been a previous resistance. The market pulls back, clears it, found support at this point, found support at the same region. Now, this support and resistance, they are not an exact price, they are region. So do not say that the exact support is 162. No, you can say support ranges from 160 to, like, let's say 165. So that's a region. So you can see how it pulled back to that region, and then how it also found support too, which also coincide with the 100 days moving average. So this is an important point. Now notice the pin bar again, how the stock went to as low as 160, and then buyers were able to step in to take up the stock price back to 165, and the stock is up by 0.84%. Now notice how all these stocks that I've mentioned so far, are moving in line with the overall index. So it's not good for you to start buying a stock when the overall market is just pulling back, or when the market is about to dip. Always wait for the market to find bottom. You are moving in line with the market. That's how to trade stock. A lot of people will just want to jump into the stock because the market is going up. You don't buy at the top of the market. When you buy stocks at the top of the market, people are going to use you to take profit. And when you buy from people at the top, Who are you going to sell to? Nobody. That's how people lose money. But when you buy at the bottom, as price begins to recover, buyers are going to step in to push the price higher, and that's where you can sell at your own price. So if you want to be profitable in this market, you need to master the swing trading strategy that I mentioned in my previous video. You will see the link down in the description. I shared how you can swing trade stock profitably, how that picking the stocks that are in a confirmed bull run, buying them when they have just pulled back to one of the averages, and also making sure that the price are undervalued compared to the fair value of the company gives you the higher probability, the higher chance of making money in the market. Because when you buy stocks like this, you increase your chance of buying the right companies that will attract buyers' attention. So this is MMC. So you can see the moving averages are lined up, the 50 above the 100, the 100 above the 150. So that passes our checklist, and you can see the huge rally on the stock. You can see here. So the stock, you can see for the last time it found support at moving average was in 2021. That's like in March. From there, notice how MMC had moved from 114 to a high of over 172. So this is it. So you might also want to ask, what is this MMC? What's their business? So on Yahoo Finance, you can always find that here. So you can see Marsh and McLennan Companies, a professional service company, provide advice and solutions to clients in the area of risk, strategy, and people worldwide. It operates in two segments: risk and insurance services and consulting. The risk and insurance service segment offers risk management services such as risk advice, risk transfer, and risk control, and risk and mitigation solutions, as well as insurance and insurance brokerage, catastrophe and financial modeling, and related advisory services and insurance programs. So you can read up the business of this company. So what are we interested in right now? We want to see the financials of this company. Let's see if it has achieved consistent growth in revenue, profits, and cash flow. Now, because this is an insurance, this is an advisory company that plays in the insurance segment, we do not really expect their debt to equity to be very, very low, like Nvidia. But to a very large extent, if the earnings before interest and tax can cover up for interest expenses, just like what you see here, EBITDA is 5. You can see here, that's, let's look at the figures here, 5,000. Okay, so this is like 5 billion. So 5 billion compared to 463 million. So this already passes my major checklist of debt exposure. So I want to see that the earnings before interest and tax actually covers interest expenses itself, which tells that the company can comfortably pay back its interest expenses without dipping hands into other account heads, or other, or sometimes without resorting to borrowing more funds. So the company is a good one. Then you can see the revenue: 16.6, 17.1, and 19. So it has achieved consistent growth in revenue, with trailing 12 months telling you that the company is on track to beat its previous financial year. Then what's the profit position like? 1.72 and 2.7. So this is also a sign of consistent growth. Net income. So we've talked about interest cover. So let's look at the cash flow of the company. If the company is cash flow positive, both at the operating end and also at the bottom section, which is free cash flow. So I like to see a company generate positive cash flow, because profit itself it's not enough. So it's the cash you generate from operating activities that matters, because you might generate a lot of profit, but there's none in the bank. So you need to look at the cash flow so that you don't get deceived by the increasing numbers at the bottom line, but the cash flow it's not speaking excuse me, the same language. So this is operating cash flow right here. So 2.3, 3.3, 3.4. So there's consistency in operating cash flow. Free cash flow too is 1.9, 3.0, 3.1. So I like to see stability in a company just like this. slow and steady. 1.93 and 3.1. So let's plug in our figures now. So this is going to be 3.1 billion. So 3119. So I'll go back to my fair value sheet, symbol MMC. So here 3119, 163, 163. So that's that's the free cash flow that we've just entered. So let's look at the statistics of the company. So we're looking at the cash position, the debt position, and also the number of ordinary shares. So that's what we're going to look at right now. So let's wait for this to load before we plug in. Okay, so this is the total cash 1.4 billion. So we're going to plug in our total cash of 1.4 billion, 1.4 here, and then we're going to plug in our total debt of 12.98 billion. Now, if you recall what I said earlier, this is a company that will be exposed to debt as or you expect, but it's not the an amount that matters. A company that is exposed to debt to the tune of 12.5 billion may be better than a company that is exposed to debt to just 1 billion. It's not about the figure itself, but the interest cover. The company that is exposed to debt to the tune of 1 billion might have an interest cover that is less than zero point 0.2, but the one of 12.9 billion might have an interest cover of 10. So if you have that two scenarios, always go for company with higher interest cover, meaning that they are generating enough revenue to pay back interest expenses, and then if it has enough cash flow. So do not always judge or look at the company's debt position by nominal figure. Always look at the interest cover, which is in earnings before interest and tax to interest expenses. So that's how you look at the interest cover. Then the number of ordinary share is 504.9 million. So 504.9 million. So that's ordinary shares. So let's now look at the projection. What are analysts projecting in the next 5 years? What are analysts projecting in the next 5 years? So analysts are projecting 12.98%. So you normally plug in 12%. So based on this, we have free cash flow of 3.1 billion. We have projected growth rate of 12%, share outstanding, debt position, and cash position. So you see again that MMC fair value estimate is $201, margin of safety is 140, and current share price is 165. So the company is 21.9% undervalued. 21.9% undervalued. So MMC at this point, you can see here. So when the price dip close to this region, and then I saw, although I already have my support line marked before the dip, so I wanted to see recovery around that support region. So which is why I mocked up some units of this company. So this is MMC. So we've talked about Nvidia, MMC, and then the third company that I have been buying since yesterday is his Kays. Kays. Now, if you look at each of the companies that I just mentioned, each of these three companies that I just mentioned, you would notice one simple trend. They all have their moving averages lined up sequentially, not one going below the other, especially the 50, 100, and 150. These are my three most important moving averages. When they are lined up like this, that's a sign of bullish run. So even when there's a pullback, I want to see a pullback at one of this average. Now look at the last time we had a dip. So the 100 days moving average. Yeah, that was 161. So if you had keyed into this stock at this point, you would have moved. You can see how it moved from 161 to over 207. So if you do 207 minus 161, that's like 46. So you would have added $46 to your share, which is like 28% between October and December. So it's not bad, 28%. I go for stability. I don't preach overnight riches in the stock market. I preach stability. Go for stable return, go for predictable return, go for returns that you can replicate, especially when you buy into profitable companies, companies that have achieved consistent growth in revenue, profit, and cash flow. These are the kind of companies I buy for swing trading. I don't gamble. I don't jump into a stock because it just announced that, oh, and everybody's buying because the price has gone up by 100%, 300%. Yes, it's good, but I want to achieve consistency in my portfolio. I want to grow my portfolio in a way that is that can I can repeat without the cost to exposure to sell off. So even if the market dips, this if you are buying into a profitable companies that are undervalued, they are always the first to bounce back when the market recovers. So if you especially when you move in line with the market. For instance, when the market peaked and you started buying, you would have lost a lot of money. But if you follow the market, as it peaks, you wait. So as the market keeps going down, you are following the index until it dips to the one of the moving averages. Then you start watching for signs of reversal. Now, if that reversal comes or if that bounce actually happens at a major support line, just like I see here, you can see this was previous resistance, now turns support, and now support again. So if the reversal happens at this major point, and it also coincide with one of the averages, it's always a sign. Especially when you see a pin bar pattern like this, the pin bar candlestick pattern, you can see how the stock has been selling off successively from 28th of December up to how it dipped from 207 down to a low of 182. You can see here. So the stock has been dipping successively until it found support. So this is a sign that buyers might be stepping in very, very soon. So this is Keysight financials. So you can see the revenue 4.2, 4.9, 4.3, 4.2, 4.9. So we've had consistent growth in revenue 3.8, 4.3, 4.2, 4.9. So this is trailing 12 months, the same thing as previous financial year, meaning that the company just ended its financial year, so which was October. So let's look at the profit position of the company. So it actually made a loss in 2018, then it swing into profit 715, 716, and then 1 billion. So this is 716 million, 715, and then 411, and then 1 billion. So it's been growing. Then earnings before interest and tax, like I told you, 1.3 against 79. So when you divide earnings before interest and tax by interest expenses, what do you get? If the interest cover is more than 2, then you are good. So that's a sign of a company that's not exposed to debt. So let's then look at the cash flow position of Keysight. What's the cash flow position of this company? So I want to quickly open the estimates right here, what analysts are projecting, and then what's the cash position, debt position, and also number of ordinary shares is. So operating cash flow positive 555,998, 1,000, 1,016,000, that's 1 billion, sorry, and 16 million, then 1.3. So that is good one. Then free cash flow positive, you can see 423, 878, 899, 1148. I mean that's 1.1 48 billion. So let's plug in our figures to see what the fair value of this company should be. So cash flow 1148. So yeah, I have 1148. 123, 123. So that's 1.1 billion. And then let's look at cash position. So statistics. So total cash is 2.05 billion. Total cash is 2.05 billion. Total debt is 2.02 billion. And the number of ordinary shares of this company is 183.04 million. 183.04 million. 183.04. So what are analysts projecting in the next 5 years? Analysts are projecting a growth of 12%. So we come here, we plug in our growth rate of 12% of the stock. So let's confirm that too. So yes, 12%. So we have this. So we have our free cash flow, estimated growth rate in the next 5 years, share outstanding, debt level, total cash. So what should this company be selling for based on this data? So my fair value is $227 and margin of safety 159. Current share price is 189. So from this, the company is 22% undervalued. 22% undervalued. So if you come here, you can see. So the fair value is 227%. So 227% still sit above this region. So at this point, this is considered an undervalued stock. You can see here. So from technical perspective, we've been able to pick stocks that are trading at one of the major averages and also likely support region. And then from fundamentals too is considered undervalued. Remember, the market is just emerging from the bottom. So we are not sure if it's the final bottom. So that's why it's not advisable for you to buy all the units of stock at once. So just go in gradually, maybe out of 100% of your cash, you can plug in 30% to see what happens. If the market continues to rally higher, you put again 30%. Then whenever you have a confirmed reversal, that is where confirmed bull run, that's where you can then go in fully. But at this point, this is a stock that I am also buying too. So that's how I pick stocks for swing trading. I follow the market. I buy when the market is down because that is where you pick stocks at cheap price. So market dip is like promo in the stock market. It's like Black Friday. Stocks are cheap right now, 20% discount, 50% discount, just like you see here. So when a product is selling at a discount, it's like a promo. And what happened? It means you can buy them at their lower price. And when the price goes back to its normal position or where it should be, you can sell back and make your profit. So when you walk into a supermarket and you see Black Friday, a TV that was supposed to be selling for 300,000 naira or $300,000 is selling for 150, and you know very well that the TV should be worth more than that, you quickly buy. And when the price goes back, you can sell to whoever wants to buy from you at the normal price, and then you pocket a profit of 20%. So that is how you trade stock. You don't trade stock or you don't swing trade when the market is at the top. You wait for a dip, you wait for a pullback at one, a major support region. Number one. Number two, one of the key moving averages. And number three, make sure the overall market too is down. Like, let's do a recap. Look at Nvidia. Look at Nvidia. You can see one right here, which coincide with this point. Look at MMC right here, which coincide with this point. And then look at keys too, right here, which coincide. So this is how to pick stocks for swing trading. So if you're interested, if you're looking for stocks to buy, this might be the stocks you need to swing trade right now for profit. So my estimated return from these three picks is minimum of 20%, 30% return if the market continues to rally higher. So this is how I pick stock in a bearish market, and this is how to swing trade stocks for profit. So please don't forget to like my channel and also share your comments. If you have a question, feel free to use the comment section. I would always be right there to respond to your queries.